metals are going to go a whole hell of a lot higher. This was something I think, that we should have expected. This is a market where we had massive short positions in London and in the US by the commercial banks that were hugely underwater. And I think they used this optimism as an opportunity to right their balance sheet and to push silver below $30. It was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long.
Gold and silver prices are expected to rise significantly, as the market has been influenced by massive short positions held by commercial banks in London and the US. These deeply underwater banks likely use the optimism to rebalance their positions by driving prices down, particularly below $30. However, once these short positions are covered, prices will likely rebound, with commercial banks shifting to long positions, causing a sharp price increase. AndySchectman, the president and CEO of Miles Franklin Precious Metals, and a well-renowned speaker, explains that silver markets are experiencing more acute pressures than gold, with stockpiles at the LBMA, COMEX, and Shanghai Metals Exchange steadily depleting. Unlike in the past, countries are now standing for delivery methodically, avoiding rapid actions that could trigger defaults. This strategic approach undermines the West's efforts to maintain the illusion of strong bond and currency markets. Andy points out that silver faces significant challenges, including a 4 to 6 billion shortfall in London and 700 to 750 million ounces of mostly naked shorts on COMEX. The situation persists as global buyers increasingly favor metals over U.S. treasuries, signaling a potential end to this system. Meanwhile, European banks are accumulating gold at levels closely aligned with their GDP, suggesting preparation for a potential gold revaluation. Similarly, BRICS nations are amassing gold and silver, possibly as a prerequisite for global influence. Countries like China and Russia are discreetly acquiring gold, while India has purchased record amounts of gold and over 900 million ounces of silver in the last 4 years. This coordinated accumulation places a floor under precious metal prices, with these nations prioritizing physical delivery despite market manipulation attempts. Their strategy ensures long-term dominance in the face of declining Western financial influence. As you watch the video clips, please take a moment to like, subscribe, and hit the notification bell to stay updated with our latest uploads. We appreciate your support. Enjoy the video.
I think it's more acute in silver than it is in gold. And if you look at the stockpiles of the metals that are being held at the LBMA, at the COMEX, and even at the Shanghai Metals Exchange, they are drawing straight down. And what's different now over the last few years, and I would say it started really in 2020, than any time that people have been following this market. And look, I go back to 1990 following this market. That's when I started in this industry. For my entire career, no one stood for delivery. Never. I mean, less than 1% of the contracts did. But this is what's different now. And these countries are smart enough to be methodical about it. So they're standing for delivery. They're draining the LBMA. They're draining the COMEX very slowly, very methodically. If you do it too fast, you get a force majeure. You get some sort of a default and the whole thing blows up. You cut off your nose to spite your face. Instead, they play the game with the West. And the game that the West has played is to support the illusion of the strength of the bond market, the strength of the currency. And they never counted on these countries being coordinated, sophisticated, motivated, and wealthy enough to stand for delivery, but also smart enough to do it in a methodical fashion, to not raise the red flag fast enough. But I think in the silver market, look, there's a 4 to 6 billion ounce shortfall in London. 4 to 6 billion. That's why they tried so hard to drive the price down here into the end of the year, closing out the stops, letting their balance sheet kind of level off, and they'll take the other side of that. And there's between 700 and 750 million ounces short on COMEX. Most of this is naked, meaning there's nothing behind it but a big checkbook. And so they've been able to keep the game going for a long, long time, but it ends when the rest of the world continues to buy metals because they don't want our treasuries anymore. So gold, and as a percentage of gold to their GDP, it's almost identical. It's almost like they're preparing for a gold revaluation. And look at the amount of gold that all the BRICS nations are buying. And I think that's prerequisite for a seat at the table. And being let, I mean, Saudi Arabia tried to buy it without reporting to the IMF. China's been doing it. and buying all the doré, being less than forthright. Russia's not telling us. China's the second largest producer of silver in the world and now a net importer after being a net exporter. If the People's Liberation Army buys instead of the PBOC, they don't report it. The doré and concentrate's not reported. You know, I just happen to think that these countries are putting a floor for sure under the price of gold and silver, and it's been admirable, if you will, in the way that they've constructed it. I mean, they're continuing. I mean, look at India. India's buying record amounts of gold right now, and they've bought over 900 million ounces of silver in the last 4 years. That's more than that's on the LBMA. So, when you talk about putting a floor under it, you're absolutely right. Now, I'm not saying that this is going to hold through the night because the bullion banks are pretty tough, but gold's up $18 right now in the aftermarket after getting hit. This is just another way for these countries to go ahead, hit it. We'll stand for delivery. We'll push it right back up, and we don't care what you do with the price because in the end, we're going to take delivery, and that's how they win until they no longer allow delivery.
Andy highlights the rising 10-year Treasury yield, which is creating stress in debt markets and banks heavily invested in these bonds. The Federal Reserve faces a dilemma: intervene with yield curve control, risking inflation, or let the debt problem play out, potentially leading to bank failures and consolidation. Meanwhile, despite being up 30% this year, gold is overlooked in favor of high-risk assets like crypto and tech stocks. However, central banks are aggressively accumulating gold, signaling its enduring value. Moreover, investors are urged to diversify strategically by taking profits from risk-on assets and reallocating to undervalued hard assets like gold, silver, and commodities. This approach not only hedges against a falling dollar but also builds resilience in a volatile market. Gold and silver outside the surveillance state financial system remain crucial stores of value, heavily favored by informed traders. Now let's get back to the interview.
We see happening again with the 10-year Treasury. It's going up. The debt market's selling off, and the banks are loaded up with 10-year Treasuries. It's a repeat of the same problem, again, as the back end of the market continues to go higher. So what does the Fed do? Do they step in and impose yield curve control, which by the back end of the bond market, which leads to massive inflation? I mean, the problem is we have too much debt, and that has to be resolved, period. And it will resolve itself not only in the form of failing banks, Kaiser, to your point, and I do believe there will be. The question is, will they be bailed in the way that Little Bank of Lindsay, Oklahoma was? And I have a feeling that it will. You want to consolidate the banks, there's no better way to do it than let a bank fail. And I don't think the final chapter has been written on that. And so when you talk about low premiums, it's in a completely all about the environment, pretty much for the last year. The drive has been risk on. Nvidia, Bitcoin, Apple, and now massive drive into the stable coins and crypto. And gold has been ignored, yet it's up 30% for the year. It's not sexy enough. It's not fast enough. It's not in your face enough. And so it's beat the S&P for the year, but it isn't returning triple digit gains the way that other things are. And so it's been ignored. And that's the wrong thing to do because it's misdirection, right? I mean, the biggest money in the world knows the playbook, the central banks, and they continue to buy hand over fist. And so I think it's kind of one of these deals where, it's intoxicating and the dopamine rush of making the profits in these risk on trades. But I think, look, it's easy for me to say what I'm about to say, but I mean it. So help me God, I mean it. And I used to do this with mining shares, and I would build my mining share position with metals. When the price would go up, I would take some of it, profit, and put it in mining shares. Well, I would say that our two communities, the crypto community and the precious metals community, have too much of a symbiotic relationship to be adversarial. And the way that you strengthen your position is to take some of those profits and put it in the undervalued hard assets that the central banks are doing. And I think you'll be glad you did. You leave the casino with a pocket full of chips. You can leave the original investment there, let it ride, pull some profit off, put it in hard assets, and continue to do that. Not only do you build a more diversified portfolio within the primary trend of a falling dollar, you're not broadly diversified. You're diversified broadly within the primary trend, which is of a falling dollar: cryptocurrencies, farmland, physical precious metals, mining shares, oil and gas, all of these things. That's how you win, instead of being completely myopic and putting everything in one area because it could never go down. What could possibly go wrong? And I think if that mentality were a little bit more pervasive, I think you would see not only it much more difficult to get product, you'd see premiums much higher. But there's been a lot that's been siphoned away into the crypto space from precious metals. I don't think that will last, whether it be the broad market selling off, the debt market selling off, even if crypto doesn't. I just think that there'll be an awakening to there are very few places left to put your money that isn't in a surveillance state type of matrix and that offers value. And I think you put it all together, that is what gold and silver are, and also being wickedly accumulated by the most well-informed traders in the world. That has to stand for something.
Gold and silver are poised for significant price increases, driven by commercial banks covering short positions and strategic accumulation by global powers. With silver facing more acute supply pressures in countries like China, Russia, and India, building substantial reserves, the value of these precious metals is expected to rise as Western financial systems face growing instability. Investors are encouraged to diversify into hard assets like gold and silver to hedge against market volatility and inflation. How might the accumulation of gold by global powers affect the future of the US dollar and its reserve currency status? What are the risks and benefits of reallocating investments from high-risk assets to gold and silver in the current market environment? Do you agree with Andy's predictions? Let us know in the comments below. For more content like this, don't forget to subscribe to our channel, hit the notification bell, and explore our other videos. Thanks for tuning in.